Hey there. Welcome to Real Stories in Real Estate. Today, I wanted to do a replay of a webinar that we did that actually got a lot of people's attention. This is a very common thing that people are talking about regularly. So I wanted to share this with a bigger audience than just the people who showed up on the day we did the webinar. So today, we're going to talk about getting ahead before you downsize. So people who are in their homes, they've been in it for usually a long time, 20, 30, 40 years. Their home is still working for them, but at some point it's not going to. So they have dreams of maybe downsizing to a cottage, a bungalow, or a condo. So, in case you didn't know, this is a team I work with. So, these are the four incredible women, including myself, that you might talk to once in a while when you call our office. We work with all kinds of people to help them with mortgage solutions. We have over 60 lenders and hundreds of different mortgage products. And this is just like a shameless reminder that if you didn't know, it doesn't cost you anything to talk to us. And lenders pay us to set up the mortgage for you, but we make sure that you get something that works for you. So, especially in these types of more complicated scenarios, you may want to work with somebody more advanced with a few different options for lenders so that they can really contrast all the pros and cons of all of the different options. You'll see as we're going through this, we're talking about just working with your bank. They don't have all the options that we're presenting here today, and some might be better or worse than others in terms of what is right for you. Disclaimer, there is no right solution for everyone. Everyone's situation is different. Everyone's priorities are different. But I encourage you to just keep an open mind and we're going to take a look at a few different things we talk about often with people who have free and clear homes or small mortgages. Okay. So um, we are in this condition of a perfect storm right now. So there's a few reasons why. So there are less buyers for your large home, right? So if you have this big home and it's paid off or small mortgage and you go to sell it, you're going to get less for it right now than you would a couple years ago. And it's just there's not as much demand for those homes over $1 million. I see it in my own neighborhood that there's a lot of for sale signs and not a lot of people shopping. So it's really not the ideal time to sell your house right now. Number two, the condo market is really, really, really suffering right now. Did I say really? I did. Okay. There are even less buyers in the condo market, which means if you had this world where you thought at some point you want to downsize to a condo, it might be a beautiful time right now to get a sale on the place that you are going to live the next years of your life. Okay. And because it's a buyer's market, you also have more time to think about that purchase. You have more time to take your time and look at things and think about it and see if you see yourself there because the condo market is really suffering right now. Okay. And that can be good for buyers. Number three, uh, there is increased demand for creative mortgage products, which means there's more coming on the market. So recently we saw Home Trust, who's a long-term lender in Canada, launch a reverse mortgage solution. There are more creative products coming for people who do not fit the regular income stress test. And as a result, more products means usually more competition, which means better products and also better interest rates. So the opportunity you may have right now is to buy your next property on sale, right? So buy a condo property on sale and then wait for your property to increase in value before selling. So then you have a plan in place for the next steps in life, right? With everything, timing is everything, right? And this allows us to have extra time to do all the things you need to do and to decide when it's right to move. And also to have that extra time to stage and sell your current home or do any renovations if you need to do them. So this can be a really great opportunity. I always think about my own parents. We were hiking a couple years ago, and my mom fell and broke her leg. And in that moment, we started to think like they have a home they live in, and they're very happy there, and that's great. But in the event that something happens, like you fall and break your leg, it's going to be really difficult to do stairs. Especially if like your bedroom is upstairs, your washroom is upstairs. Like, this can be a really difficult thing. And maybe it could be something more serious than that. I don't wish that on anyone. But in those moments where something severe happens, you don't want to also panic and start to do all these other things in the process. It's really nice to have a plan of where you're going so that you don't have to stress about it later if you're not in control of the timing of when you need to move. So, who does this work for? So, you have a family home, it has a small mortgage on it or no mortgage at all. You're healthy and you're not ready to move or downsize, but you know in the future that you might want something without stairs. And you want the security of knowing where you are going to downsize to when you are ready. So here's a few steps. So step one, we're going to do some strategic financing on your home, and I'm going to outlay what those different options are next. Two, we're going to purchase a condo, or maybe it's a bungalow or a cottage or wherever you want to go next. Um, with the money that we got from the first step, and then possibly rent it out until you're ready to move there. And three, when you are ready, then you're going to move into that property. You're going to sell your current home. And then you have time to stage and move, right? You've got lots of time on your side, and the financing is set up so that you don't have to stress about it. And I'm going to show you what that looks like in real numbers soon. So what we want to we know what you're going to say, right? I don't want to get a mortgage again. I already paid mine off. Guess what? We need to think as investors right now, or being more strategic. We need to leverage some financing vehicles in order to get us where we want to go. And I'm going to show you how impactful that can be. Two, I don't want to be a landlord. I get it. Well, some of these options actually have a surplus of cash, in which case you could just hire a property manager. The average cost for a property manager is usually about 1 month's rent for the entire year for them to help you look after the property. So it's a pretty inexpensive investment if you do not want to be a landlord. And three, I'm not sure I can approve or afford to have two properties at once. Well, that depends on the financing vehicle. So that's the discussion we're going to have now. So here's a real scenario. So I want to show you the numbers on a real scenario of what this looked like for honestly, this is a very typical scenario. We've had these discussions more than once with people already this year, and it's only been a few weeks into 2026. So the current property value is 1.2 million. Guess what? It was 1.4 2 years ago, and it probably will go up to that in the future. But right now, it is lower in value than what it was previously. Um, their current financing. So they owe 50K on a bank mortgage left. And then they had $50,000 HELOC, but they didn't actually owe anything on that. They hadn't used it. And then they want to purchase a condo in about the $500,000 range. And again, this condo was 600 to 650 a couple years ago when condos were really, really big. But now they're able to get a discounted price on that condo, which is pretty cool. And they were in their mid 70s. So very healthy people, not in a rush to leave their family home. And they had no kids at home, but they still had their kids and their grandkids visit often. So they weren't ready to give up that big family home yet. So in this market, if they looked at just selling and moving to a condo, here's what the numbers would work out to. So if they sold for 1.2 million, paid off their mortgage, paid their real estate fees and the tax on the real estate fees and the legal fees, they would walk away with just over $1 million. And then the approximate closing costs for the purchase. So if they bought for 500,000, if the condo is not in Toronto, so they're not dealing with municipal land transfer tax, there's the approximate closing cost. So that would cost them about the 500,000 plus about $12,000. So that leaves our clients with the home sold and a new condo owned free and clear with no financing on it whatsoever, and $568,000 in change in their pocket to live on. If they were to refinance and buy, so let's say this current home, they decided to keep it and they refinanced. So they made a new mortgage. The new mortgage is going to be for 570. We need 500,000 for the condo. We'll have $20,000 for the closing costs, extra fees, and just like what if to make it safe. Plus, they have to pay off that $50,000 mortgage they have. So that new mortgage at today's rates is going to cost them about $2,821 a month. They're going to buy the condo for cash with that money, and they're going to rent it out for $1,500 a month because they're not ready to move there yet. The condo fees are $450 a month. So that leaves our clients to live in their current home, to have a condo rented out. And the total monthly cost to own two properties in this scenario is $1,771 a month, plus the utilities on both properties, um, as both properties go up in equity. Okay. What if we did a line of credit instead? So, a line of credit, we have the same financing that we need, but the payment is going to be slightly different. So, $2,351 a month is going to be this payment. And so, same scenario, they stay in the current home, they rent out the condo, and then the total net monthly cost is only going to be 1301 per month. So, if I go back, this is 1771 per month. The line of credit is 1301 per month. And the reason why is because the line of credit, we can make interest only payments. So they're not actually paying that down, but they are making less of a payment a month. So if cash flow is a concern, right? If we don't want to pay too much to own both properties, this might be a better option for you than the mortgage option. The next one we're looking at is a reverse mortgage and buy. So if they reverse mortgage the current property and they were able to get out the 570 at today's rates, okay, this is actually not true. There's no payments. So let's say we're averaging rates, it's going to average about this, but you're not making those payments. So with a reverse mortgage, what happens is that you don't pay off the mortgage each month. You make the mortgage payment plus the interest when you sell the property or when you pay it out. So I'm going to show you that in a little bit. Uh, but essentially, what you really need to understand from this concept is it's the same thing as the refinance or the HELOC option, except we're ending up with the two properties. So we're still staying in the house, we're renting out the condo until we're ready to move to it. But under this scenario, the clients actually have $1,050 a month in their pocket from that rent because they're not making monthly mortgage payments. So that's extra money that goes in their pocket. So they're being paid to own two properties. That's the extra money to cover a property manager. It could be, to cover all of your utilities and stuff on both homes or just to travel. Okay. If cash flow is an issue, maybe this is a better option to get us into two properties. So, what happens when you sell? Okay, the standard mortgage, we're going to pay off the mortgage. You can see it's lower than the 570 we started because some of the mortgage payment does go to principal. There's going to be a penalty to pay that off. There's going to be realtor fees, tax on the realtor fees, and legal fees, right? So we're saying, what if this house went up in value to 1.4 in 2 years? Then essentially, the standard mortgage, when you sell that house and you just stay in the condo, you're going to walk away with $769,000 and $900 surplus from your sale. In the line of credit, you'll see that there is no penalty, but we didn't pay as much down, right? We paid nothing down because we were only making interest only payments on the line of credit. So that's why you're going to have a slightly smaller surplus on the line of credit. Now, with the reverse mortgage, you can see that we have $570,000 mortgage plus the $70,000 interest that we did not pay during the couple years that we had it, plus the realtor fees and HST and legal fees. So we're with a reverse mortgage, when we sell, we are walking away with less, right? You're only getting $678,900. So slightly less with the reverse mortgage. But remember, if we sold today and we bought a condo, we would only end up with $568,000 in change in our pockets. So each one of these options, the standard mortgage, the line of credit, or the reverse mortgage, to hold on to two properties for longer, and so that you can better time when you do want to sell when the market is better, is still going to make you more money than selling right now. The point with this is not that like this is the case for everybody. The point is that if you are in control of the timing, you are going to be farther ahead, right? What makes us lose money in real estate is not being able to control what we do in it. When we have to sell, no matter what happens and no matter what's happening in the market, that is not the same as waiting a year or two until the market is in a good spot for us to sell. So, what are the other considerations? So, with a standard mortgage, we need the income to qualify for it. We need to have emergency money or extra for extra expenses because that cash flow is tighter. It does cost you more to own two properties, and it may impact your life if it costs you too much to own two properties, and then you are um, living a little tighter than you're used to. Right? You're not traveling as much. You're not going out for dinner as much, right? So that could be a concern for some people with the line of credit. Same as a standard mortgage, but you actually need more income to qualify because the rate is slightly higher. You will need more income to qualify, but it will have less cash flow impacts because the payments are lower each month. With a reverse mortgage, there's no income qualification, but you will need to meet requirements in terms of having enough equity in your home and being a certain age in order to access that equity. It's obviously the best option for cash flow, but there are also some other things like potentially if you still have adult kids living at home, you may not be eligible for a reverse mortgage. So there's some other stipulations about that in terms of qualification. It's not income qualification, but there is still some requirements that need to be met. So if we're saying that we sold in 2 years, then these are the breakdown in numbers, right? Just so you can see them the way it looks. So the standard mortgage is going to cost us $1,771 a month to own both properties. The line of credit is going to cost $1,301 a month to own both properties, right? So, and then in the reverse mortgage, it's actually paying you $1,050 a month. So the net cost to you for owning two properties on the standard mortgage is $42,504. But you do make that extra 763,000. The line of credit, it's costing you $31,224, but you're making $748,000. And in the reverse mortgage example, it paid you $25,200. But when you sell, you also make that $678,000 when you sell your current home. So, what should you worry about? Well, you worry that pricing changes on what you are selling or buying, because then all of a sudden that strategy might not work. The mortgage options, products, regulations could change that can impact what you can do, right? I'm giving you a generic example of a few people I've talked to, but for your specific example, we have to go through what you actually qualify for. Some of these options might not be available to you based on your situation. Um, and then waiting too long to create a solid plan for yourself and then being less in control of where you move next. And I think that's the real worry is just when you have certainty and you know where you're going next, I think life can be a whole lot less stressful. So, what are the steps? We're going to do a call and talk about your current situation and your goals for the future. Where do you want to move? What does that look like? What do properties cost in that neighborhood and see what we can figure out. Then we'll collect a few documents and then we do a full strategy call either in the office or virtually. Usually we do those on video where we go through a customized action plan for you and basically break down the three things that we just did here. So mortgage, HELOC, and reverse mortgage, and what options you have available to you based on your specific example. If you'd like one of them, maybe we action the plan. That's phase 4. And phase 5, you go shop over your next property with full confidence and safety and all the time in the world because you've got all the money to be able to do it without stress. So let's build your future together. If you would like us to help you, you can reach out to the office 289-645-1568 or experts at laframboisemortgage.ca. We would love to help you plan for the future to have a concrete idea of where you're going and what is possible for you. I hope you found that valuable, and if you did, please share with a friend. We or probably in this case, more likely share with your parents because it really is a great market to be able to take advantage of keeping your current home, but buying that next place so that you know where you're going to move when you are ready. Thanks so much.